Most people only watch one number when checking their money, the stock market. Red day, green day, that's the whole story, right? Except that's not where the story actually starts. For the past couple of years, the real action has been happening in the bond market. Treasury yields have climbed to levels we haven't seen in decades, while everyone's attention stayed locked entirely on stocks instead. Here's the part almost nobody explains clearly: when bonds crash first, stocks very often follow, sometimes weeks or months later. Today I'll show you exactly why that connection exists, using what's actually happening in the bond market right now, honestly. Let's start with something that trips people up immediately. What does it even mean for a bond market to crash? Here's the key mechanic: bond prices and yields move in opposite directions. When prices fall, yields rise, always inversely. So when you hear the 10-year yield pushing toward 4.7, 4.8%, that's the bond market crashing. The 30-year climbing past 5%, levels we haven't consistently seen in a long time, even though headlines rarely say crash. Persistent inflation, massive government borrowing flooding the market, and investors demanding bigger premiums have all pushed yields higher recently. Whatever the specific cause, the effect is the same: existing bonds lose value, new bonds must offer higher yields. Now here's where most people's understanding stops: they think bonds and stocks are separate markets doing their own things. They're not. They're deeply connected through something called the discount rate, a concept worth actually understanding properly right now. A stock's price represents all future profits, converted into today's dollars using an interest rate for that exact conversion process. When bond yields are low, that math is generous: future profits still look very valuable in today's dollars. But when yields rise sharply, future profits get discounted more heavily, meaning the same earnings are worth noticeably less today. This hits high growth, high valuation stocks especially hard, which is why tech and growth stocks often lead the way down. There's a second reason bonds and stocks are connected, and it's simpler: they compete for the exact same investor money. When treasury bonds yielded barely 1 or 2%, stocks were often the only realistic place for meaningful returns. But when a safe, government-backed bond yields 4 or 5%, it becomes a real, credible competitor for that money. This shift pulls money out of stocks into bonds, adding extra selling pressure on equities right as yields climb higher. It's exactly the kind of dynamic that's been playing out through 2025 and into 2026 as yields marched steadily upward. Here's the confusing part: stocks don't always fall the moment yields rise, sometimes there's a real, noticeable lag. We actually saw this recently: bond yields climbing sharply while stocks kept pushing to fresh highs simultaneously, defying expectations. Driven largely by strong corporate earnings and enthusiasm around artificial intelligence, analysts called it a decoupling of the two markets. But historically, this kind of decoupling tends to be temporary rather than permanent, eventually giving way to the underlying math. The lag isn't proof the connection doesn't exist, it just means other forces are temporarily outweighing it, for now. This brings us to the actual myth worth naming: that bonds are the boring corner of the market, irrelevant to stocks. That framing misses one of the most important relationships in finance: bonds effectively set the price of money everywhere, influencing mortgage rates, corporate borrowing costs, and the actual math behind how stocks get valued in the first place. Professional investors watch bond yields closely for exactly this reason: bonds often move first, giving real context for stocks. So what do you actually do with this information, practically speaking, as a regular investor watching all this unfold? First, rising rate environments hit high growth, high valuation stocks harder than steady, established companies, because of that discount rate math. If you're heavily concentrated in speculative growth names during climbing yields, know that this exposure carries extra risk right now. Second, diversification matters more during periods like this. A portfolio entirely in stocks is fully exposed to this dynamic. Some allocation to bonds still provides real diversification value over a full market cycle, once yields eventually stabilize again. Third, don't panic simply because yields are rising. Strong fundamentals can genuinely outweigh rate pressure for a meaningful stretch. The goal isn't predicting the market's next move perfectly, it's understanding the mechanism so moves make sense to you. Now someone will say, but we just saw stocks hit record highs while yields climbed, doesn't that disprove this relationship? Not quite. It shows the relationship isn't mechanical or immediate, other forces can outweigh rising yield pressure for a period. It doesn't erase the underlying math, it's a longer running force that tends to reassert itself over time eventually. So here's the honest takeaway: the bond market isn't some boring corner of finance you can safely ignore entirely. It's often the quiet, early signal for what eventually shows up in stocks, even when there's a lag before it's obvious. Understanding why rising yields pressure valuations, and why bonds and stocks compete for money, gives you real context now. If you've been watching yields climb and wondering what it means for your portfolio, now you know the actual mechanism. Tell me in the comments, were you already watching bond yields, or is this a signal you'd never noticed before? If this helped connect some dots for you, hit subscribe, because next week we're breaking down another market relationship. One that quietly explains far more than most people ever realize. I'll see you in the next one.